Hello guys, this is Oba FX and welcome to my channel where we look into basically into synthetic indices. As I promised in my previous video, we're going to be doing a series of top-down analysis on these synthetic indices pairs. So in our previous video, we did analysis on the crash and boom pairs. So if you've not seen that video, you can just check my channel and try to watch it. The video was quite the session was quite insightful. So today I'm going to be looking at four pairs. I'm going to quickly run through four pairs. The volatility 10-1S, volatility 10 index, volatility 25, and jump 10 index. So I'm going to try as much as possible to just analyze these pairs. And when you quietly watch this video, you can actually learn a thing or two from it. So like I said, my strategy is purely price action. And for those of us that know about price action, it doesn't require the use of indicator whatsoever. All it simply does, it takes the behavior of price in the past, compares it to what price is doing now, and then try to use it to predict what price would probably do in the future. Now, I want you to take note that I said probably do in the future because nobody actually knows what the market is going to do next. So, as is customary, I like starting my analysis from the monthly time frame in which I determine the direction of the market. And looking at volatility 10-1S index, we can say that the market had been in a range for a very long time, was ranging for a very long period of time, this range for a very, very long period of time, and then it broke out. Now, after breaking out of this range, it came back into the range again. And now we can see that it came back with a sea of red candles. So if by merely looking at it, I want to be predicting anything, I'll say that this is in what? A downtrend. Now, why do I say that it's in a downtrend or it's moving in the downwards direction? Just by what I'm saying, it's this. It came down to make a low, it made a lower high and then made a lower low. Howbeit, we can see that there's a big rejection candle from the base of the initial range, and it's trying to, you can see also that more buyers are trying to enter the market. So this will get more information when we start going down to the lower time frame. So, but for now, we can see that it's in a downtrend and there's currently some sort of retracement. So let's take these out and then let's go to the weekly time frame. Let me zoom this in a bit. Now, from the weekly time frame, we can see that the lower time frame, which is a lower time frame, it has the downward trending of the market becomes a bit clearer in the sense that we now see something like this: a low, a lower high, lower low, lower high, a lower low. So just like we saw in the monthly time frame that buyers are gradually coming into the market from this long rejection, from the rejection of this candle and this green candle, we can see here that buyers are actually coming into the market. So what can we infer? What can we pick from the weekly time frame? In my previous video, I mentioned that most times I pick the structure that I'll be trading from the weekly or daily time frame. Now, what do I mean? The market presents several patterns, and from those patterns, you can infer the structure that is presented before you. And it is from those structures that you will pick your key points of interest. Now, key points of interest are points in those structures that you see that would increase or optimize your chances of making profit if you take your trade, if you patiently wait for the price to get to those points and then you decide to attack the market from those areas. Now, what am I trying to say? Let's say, for example, sometimes the market presents you with a pattern like the W pattern. Now, when you have this W pattern, a key point in this pattern will be either here or here. Why? Because once this pattern is formed, there is a high probability of price retracing into this area and going back up, or price retracing into this area and coming back down to form a triple bottom before making its way back up. So if you take your, if there's a change of, a mini change of market trend within this place and you take your trade, you are likely to make a lot of profit. The same applies here, but it will be risky when price is within this place and then you start looking for trade. The same applies for to the M pattern, or maybe like this pattern. When the market is going upward and it forms a high, a higher low, and then a higher high. So if this happens, you'll be expecting the key point of interest here would be this point and this point. Why? Because you'll be expecting a retracement into this point for the market to start going upwards, or the retracement can push back down to form what, a double bottom. So for the M pattern, this would be like a key point of interest, a key point of interest here. Now you see these patterns in all the time frames. You can see it even in the 5-minute time frame. However, these patterns, the key points of interest hold stronger in the higher time frame. So that's why most times I try to get them from as high as the weekly or the daily time frame. So if the patterns are not clear in the weekly time frame, I get it from the daily time frame. So, but I also understand that there are scalpers of the market or those who day trade, because mainly I swing trade. I like to hold trades for long periods of time. So for those that do day trading, most times they take their structures from the H4 time frame. Some take from the H1 and then they get their entries from the 15-minute or 30-minute time frame. But for me, I prefer taking these patterns or structures, as the case may be, from the weekly time frame or the daily time frame, and entries from the H4 or H1 time frame. So having said that, we can see that if I'm to go to the line chart, I can see that what I have here is this, is something like this, like the M pattern. And there is currently a retracement. Remember, we mentioned earlier that the market is actually retracing. And this would be a key point of interest. This would be what? A key point of interest. And even this would be a key point of interest. So let me clear and let's map out our points of interest. Excuse me. So back to our charts, to the candlesticks. So now we've said a few things. We've said that our market is trending downwards. That's the direction from the monthly time frame, and from the weekly time frame, it's still the same thing. But however, the market is currently retracing. So now that I've seen the structure I'm trading, I can now come here and map out my key point of interest. Now, most times the key point of interest will always give you either a support or a resistance zone. Will always form like a support or a resistance zone. So if I'm to take this upwards, this is a resistance zone as well as a support zone. Now, what do I mean? When the market came downwards, it was acting as a support. It rejected the market, and then it came back down several times for several. Now these are each candlestick here stands for 1 week. Now for 1, 2, 3, 4, 5, it failed to break for 5 weeks. There was a massive rejection upwards. It came back, rejection, it came back. There was a fake breakout, moved upwards again, then before it finally broke downwards. Now, even after breaking downwards, market price came back to this zone again, and it was finally rejected downwards. And now we can see that price is gradually approaching this zone. So this will be like a major key point of interest for me. In other words, I'll be waiting for the price to get into the zone before I would attack the market. Now let's try to expand this to see clearer in the daily time frame. Now, from the daily time frame, we can see that now we can see like a closer look or a clearer look of the structure that we drew. If I put a trend line here, now remember initially we had said that the market is gradually what? Making a retracement. Retracement towards where? Towards this zone, most likely towards this zone, before it would reverse back and maintain the original direction. So now this is the daily time frame. Let's go back to the weekly. Okay. So the market made a low, made a lower high, came back here, tried to pull upward, made a double bottom here, tried to pull upwards, but the buyers couldn't take the price upwards. It came back down again. So this like a mini trend within the major trend of the market. Why? Because we are going now to the lower time frames. And this alludes to what I said before when I said sometimes when you take your structures or your trend lines from the lower time frame, it breaks easily, changes easily. Now, if I were to take this as my trend line, you'll see that it had broken. It would have broken what? Easily. Even the same applies to this. Why? Because the market is retracing upwards. Now, having now seen that this is like our major key zone, all we now need to do is, we can see that the market is coming upward already. All we need to do will be to wait for price to get here. Then we'll look at how price behaves before engaging the market. But now we have something else that we can look at in our hands. Remember, we had said that the market is retracing. So if we go to we can go to the lower time frame to see that if we can get if we can get buying opportunities as a result of the retracement, even though the market is in a downtrend generally. So if I go to H4, which usually is my entry time frame, I can go to see if we can get any buying opportunities. But why? Because one of the internal trend lines in the major time frame had been broken. Now this is our target where we can start looking for sales. So if I'm to put a counter trend line here, I'll have this. So the H4 time frame is presenting to us that the market is in an uptrend. And where is the market going to? Let me zoom this in. Where is the market going to have established that the market is coming here? Now, normally I would never, except for those that like trading in the lower time frame, I would never want to engage in this sort of trade. But just to help those who are trading mostly in the lower time frame. Now, from the H4, you could have like a key zone here. You have like a key zone here because this is a double bottom. Now, from the double bottom, this was broken. It took out the top, made a retracement back into the zone. So if for those that trade in the lower time frame, you could have first of all seen that the market is trending in the lower time frame, is trending upwards. So it made a high here, made a retracement into the trend line, formed a double bottom. Now the rule of double bottom is a bullish reversal pattern. In other words, when it appears, it means the market wants to go upwards or wants to leave the downtrend and go in the upwards direction. So immediately, if I had seen this, what I'd have done is wait for this retracement, then go to the H1 time frame and engage the market here. Then your stop loss would be somewhere here. So you'd have taken your entry here, place your stop loss here, and then wait for the market to rally up into this point. But I wouldn't do this normally. I think this would be for those who like trading in the lower time frame. And I explained earlier that the reason I don't do this is because most times The confluence that you get in the lower time frame hardly holds, except maybe you are a scalper and you won't be holding your trades for long. So this is still on. Somebody can come here. If this market retraces into this place, you can take your trade here from this point, keep your stop loss here, and then watch the market go upwards. So basically, if I'm to recap what all we've said for volatility 10-1S, we said from the monthly time frame that it's in a downtrend, but there has been a rejection, which means the market is making a retracement. From the weekly time frame, we're able to spot like an M structure, and the market is gradually going back into the one of the key zones formed by the M. This was made clearer in the daily time frame, and we could see the retracement into the zone where I would advise that we engage the market. So that would be that. So like I said, you can monitor this index when the market gets into the zone, or if the market breaks back down. When the market gets, now the market is forming meaning higher highs and higher lows. So if the market gets into this zone, then we can start looking for candlestick patterns, and then maybe also chart patterns to before engaging the market to sell the market. Also, we should take note that this could get to this point, break it, and then continue upwards. And then continue upwards. Now remember, there's a range. There has been a range here, so it could come into this place, range a while, and decide what it wants to do. So that's why it requires a lot of patience to trade these pairs. Why? Because we still have another trend line here. So it could get to this point. You watch the behavior. So it could come to test this trend line before deciding to move downwards. So there are two things here. Now that the market is going upwards, if you can get any opportunity in the lower time frame, you can just take the trade upwards, but you must be very mindful that it will either reverse here or at this point. So the market would only change its trend, its general trend, if it's able to take out this point, make a retracement, make a retest, and then continue upwards. I've spent a lot of time on volatility 10-1S. Let's look at volatility 10 itself. So as is customary, I start from the monthly time frame. So monthly time frame, we can see just by looking at it that the market has been in a downtrend for a while now. But there's something interesting about it being in a downtrend. Though it has been a downtrend for a very long time, we can also see that it had tried to take out the lower low, or the lowest point of the market, and buyers are gradually coming into the market. Now, what do I mean? We have like a low, a lower high, a low, lower low, lower high, a lower low, a lower high, a lower low. So this was the lowest point of the market. So the market made a lower high, and instead of making a lower low, it made a lower high and then made a higher high. So the market came here, took out this low. There was a W pattern here. It took out this lower high, formed a high, but couldn't continue this trend. In other words, it formed a high but came back down. And then now it had taken out, came back down, took out the initial higher low, or rather the higher low, to form a lower low. Now it had formed a lower high and then a lower low. However, this lower low is now forming a double bottom. Is now forming a double bottom. So, and buyers are already coming into the market. So, this is what I mean. This is a double bottom, these 2 points, and buyers are already coming into the market. So, what I'm trying to say is that even though volatility 10 is in a downtrend, it is currently making what? A retracement. And remember, we talk about structures. I normally take structures from the weekly or daily time frame, but just by looking at this, we can see that there is an M pattern. This, and this is like a key area in this M pattern, but this can also be what? A key area. So what am I trying to say? If we'll be expecting that since this had formed a double bottom, we'll be expecting this retracement to get into this area, into this area. So let's look at our structure, the weekly time frame. So let's make this final. Now you can see that the zone we picked from the monthly time frame can, can serve as our initial key point of interest. So if you look at this structure now, it's very, very clear in the sense that we can easily call this an M structure. This, this, it came down. So just like I said, there's a rejection candle here showing that buyers are coming into the market and the market is retracing. But we're expecting this retracement to come into this zone. Or worst case scenario, it breaks this zone and gets to this zone to form what? A double top before coming downwards. So our key point of interest will be this area that I've mapped out. So it will be acting as our resistance. But because this is a weekly time frame, this will take some time. It might take some time before it gets into the zone. So the best trading decision would be to wait for it to get into the zone. But for a lot of people who will be impatient or who are usually impatient, they might want to trade this from here to see whatever it is they can get. I normally don't advise this, especially those of us starting out trading. Trading retracement requires a high level of technicality and psychology because anything can happen when you are trading against the trend of the market. So I always advise that you stick to trading in the direction of the general trend of the market. So if I'm to put my trend line here, this is my trend, outer trend line, then this is the inner one. This is the inner one. So we have the first touch of the trend line, the second touch of the trend line. Now it broke this M structure and there's a retracement coming back. So few things are likely to happen. This market can get into this zone and then start coming back downwards. But I can also predict that the market can decide to use this zone for liquidity grabs, knowing that a lot of people will be waiting to enter this market here. So it can just take out, because if you decide to sell here, that means your stop loss will be above the zone. So the market can decide to do something, get here, just move to make a third touch of this trend line before what? Coming back down. So whichever way, you have to look at the behavior of price around any zone that you map out. So let's look at the daily time frame. So what's the daily time frame telling us? It's telling us the same thing we've seen in the weekly time frame. So you can see that the market is making a retracement upward. So like I said, we wait for price to get into this zone and then we engage, or we see the behavior of the price before thinking to what? Engage, or we wait for it to make another touch of this trend line before engaging. So for now, the market makes So, okay, for those that like taking their structures from the lower time frame, say maybe H4, they'll be seeing something entirely different. Let's look at what H4 will be. If we were to start this, let me take all this out. If we were to start our analysis, maybe for a day trader or a swing trader, if you were to start your analysis from H4, this is what you would have been seeing. It would have clearly shown you that the market is what? In an uptrend. So now, if it's in an uptrend, what are we going to be trading? So the market made a high, made a higher low, a higher high, but we can see that there's a very strong rejection zone here. There's a very strong rejection zone here. Let's zoom this in. You would have seen it that is in an uptrend. Why do I say that? Because if you had drawn this trend line, you would have seen that the trend line has been what, broken, or rather, the structure of the market hasn't changed. Sorry, I had to zoom in. The structure of the market, the trend of the market hasn't changed, but you see that the market is making mini highs and lows. However, even though the trend line has been broken, the market is trying to take out this point. So for those who trade in the lower time frame, how would I, if I were doing my analysis in lower time, how would I have entered this market? Now, I would have simply waited for the market to take out this resistance zone. So this is what I would have waited for, to take out this resistance zone, a retracement, and then I'll probably engage and monitor it closely. Why will I monitor it closely? Because of the daily time frame and the weekly time frame. They all say that it's in a what? Downtrend, because the market is in a strong downtrend. So whatever I'll be trading in any of these smaller time frame would be me trading against the general trend of the market. Would be me trading against the general trend of the market. And as a result, it can turn against me anytime. So like they always say, the trend of the market is your friend. So that would be it for um, volatility 10x, 10 index, sorry. So just to recap, from the weekly time frame, we saw that it's in a strong downtrend. The structure we saw was the M structure, and we said that the market is making a retracement because it has gotten to the lowest ever point of the market, and as a result, buyers are trying to come in. But we're saying that this retracement is likely not going to go beyond these key points in the M structure that was formed, or at most make a double top for the market to continue in its downward direction. Whichever way, we should take note of these key points and then watch out for price behavior at those points. So the market is currently making a retracement to the key points that we've that we picked. And then I said for those that like trading in the lower time frame, that what you would see if you go to your lower time frame will be the market in an uptrend. So you can see higher highs and higher lows. But however, it will be risky to trade in these um, time frames because the market can go against, because you'll be trading against the stronger general trend of the market. Let's look at volatility 25 index. So let me take these guys out. So for volatility 25 index, we can see here that from the monthly time frame, we can see also that it's in a downtrend. You can see also that it's in a downtrend. Now, what do I mean? We can see that the market made a lower high, lower low, lower high, lower low, then a lower high. Now, the funny thing is the market started ranging for a very long time. What do I mean? Each candlestick here depicts a particular month. So for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24. For 2 years, volatility 10, 25 has been ranging for 2 years. Since 2023, volatility for 24 months, it has been ranging. But the thing is, within this range, we can spot like a trend. Why? Because it's in a monthly time frame. But this is like a very, very choppy market. So it's not something that you would have been able to hold for a month and just be comfortable because it has just been going up and down. So let's see what we can. So, but however, from this now we've been able to deduce that it made like it made a low, a lower high, lower low, lower high, lower low. Now it had made a lower high and then suddenly started trending in that lower high, failing to make a lower low or a higher high. So it had failed to break out from this range for a very, very long time. So just to make things easier for us, let's just let's map the top and the bottom of the range to know that we're not dealing with a trending market. Even if it's in a downtrend, there's a range within the downtrend. So the weekly time frame will show us better. Now you can see that the range is much clearer. What do I mean? Now this is the bottom of the range, and then this will be like the top of the range. Of course, we have like another mini zone here. So I prefer to take these other two at the top as like fake breakouts from the range. So the market came in here. So, but you can see that within the range, you have like a high, a lower, a higher low, double top. So it's just choppy. I can take all this that, oh, it tried to make a high, but it came back down. So this is like a range and not even a clear range. So in a ranging market, let's see what structure can we now pick from the range to say, oh, okay, even if this market is not going upwards continuously or coming downwards continuously, what can we depict from whatever it is that we're seeing? All we can see now is that within the range, the market formed like, even though it wasn't that clear, the market tried to form different structures. I can take this as like a W. So instead of coming back down to test it, it broke below the final point and tried to come back up. So it tried to come back up, but currently it's at the top of the range. That means if I'm to pick a direction, remember we said it's in a, now let me say this, I would feel more comfortable if a market is in a downtrend generally and within the trend it goes into a range. If ever I'm to trade that ranging market, I'll feel more comfortable trading in the direction of the general trend. What do I mean? I'll feel more comfortable from trading when the range is going downwards than when it is going what? Upwards. So this is what I mean. So we had like an M here, sorry, a W here. The market came back down, almost took out the lower part of this W and then came back up. But now the market has come to a key point within the range, and there's a long rejection candle showing that the market wants to go downwards. If you want a key piece of advice from me, I'll say stay away from this market but for those of us who are well gifted technically, like we've taken our analysis far, we can start looking for um, trading opportunities this within this space. But if we go back to the line chart, we can also spot here that there is like a W. So there are a few things that can happen. We can see already that the market, there was a big rejection from this key zone, and the rejection was into this space. Let's go to the daily time frame. So now the W is a bit clearer. What do I mean? You can see this. You can see this. Came here, 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 here. And now there's a retracement into this place. Now, normally, if this were a trending market, it would be very easy to say, oh, okay, um, the market had come to test this structure, it's going up. But let's not forget that there's a strong resistance here. So what am I trying to say? If I'm to engage in trading this, let's take these structures out. If I'm to engage in trading this, now this is the daily time frame, then I'll be focusing on this structure, then I'll have to take this out with the hoping that the market will be coming to test the highest point of the range that we saw in weekly time frame. Now remember, this is a point where the market had broken off to before coming back into the range, and then now it gave us a W pattern, and has come back to retest a key point in the W pattern. So I can now take out this and then come back to the daily time frame. So now we have like a high, a lower high, a higher high, and then the market currently formed a lower high, and then we can see that there are buyers already. So this is a W pattern, 1, 2, 3, 4, with a retracement into a key zone in W pattern. So this is actually like a viable trade right now. So now how would we know that? Let's go to the H4 time frame. Now remember I told you guys that in a previous video that one way in which we take trades is by drawing a counter trend line. By drawing a counter trend line. Now this is a key point, a key zone in the W. Now the market was trying to come into this place. It did finally get in here. And what do we see before we now say, okay, we want to engage this market, we want to engage. Now, first of all, I can see like candlestick pattern. This is like there's a bullish engulfing candle here. That's number one. Then I can see like a doji candle. Doji is indicating that the downtrend is coming to an end because the market is currently trending downwards. So right now, be preparing my mind on if I'm going to be buying this market. Then also, all I need to do is to put a counter trend line. So the safest way for you to take a buy here would be to wait for the break of this trend line and then wait for the break of the trend line, wait for a retest, and you engage. Then your stop loss would be here. However, you can also go further to the H1 time frame. So some people would have entered this trade here. Some people would have entered the trade here their stop loss beneath. But the safest bet would be to wait for the break of this counter trend line, wait for a pullback or retracement, and then get in. It has been a long video, and I would like to stop here. So we've looked at three pairs: volatility 10-1S, volatility 10, and volatility 25. So if you've gained anything at all from this video, from watching this, if you have any questions, you can always reach out to me. I have my WhatsApp number on the channel. You can always reach out if you have questions. You can always drop your questions on the comment section. And if you think you want us to look into any pair to just analyze, go through it, or you have questions concerning any pair, you can always reach out. So this is Oba FX. Don't forget to like, share, and subscribe. Thanks for listening and watching.